When people think about long-term wealth, they usually focus on investment returns, market timing, or choosing the right assets. Yet one of the most powerful forces shaping financial outcomes is often something far less dramatic and far less visible. It is the small fee quietly embedded inside financial systems. A percentage that appears minor in a single year can behave very differently once time begins to stretch across decades. Imagine two investors who begin with identical portfolios and follow similar long-term strategies. Both participate in the same markets, and both remain consistent over time. The only structural difference between them is that one portfolio carries slightly higher annual fees. At first, this difference barely registers because a small percentage feels insignificant compared to the larger movements of the market. But financial systems rarely operate on single-year outcomes. They operate on accumulation. The mathematical structure of compounding means that every dollar lost to fees is not only removed once, it is removed from every future layer of growth that might have followed. A 1% fee does not simply subtract 1% from a portfolio in a single year. Instead, it quietly reduces the base from which compounding operates year after year. Over time, the system behaves less like a simple subtraction and more like a gradual compression of long-term growth. Behavioral economics adds another layer to this story. Humans tend to pay more attention to visible numbers than invisible structures. A market decline immediately captures attention because the movement is dramatic and obvious. Fees, on the other hand, appear small and stable, which allows them to pass through financial awareness almost unnoticed. Because the deduction happens quietly inside the system, it rarely triggers the same emotional response as market volatility. Over long periods of time, however, the mathematical effect becomes easier to see. Even small percentages can accumulate into large differences because they apply not only to the original investment, but also to the compounded growth that would have occurred on that capital. The result is that two investors who began in nearly identical positions may slowly drift apart financially, not because of dramatically different decisions, but because of a structural cost embedded within the system. Looking at historical financial data across many decades reveals how common this pattern can be. Markets have experienced periods of expansion, contraction, and recovery, yet the compounding structure remains constant throughout these cycles. Fees continue to operate in both rising and falling markets because they are attached to the system itself rather than to the direction of prices. Understanding the mathematics behind small fees does not require dramatic action or complex strategies. Instead, it shifts attention toward the architecture of financial systems. Once people recognize that even minor structural costs can influence long-term compounding, they begin to see wealth building less as a series of exciting financial events and more as a system where small variables quietly shape outcomes over time. In that sense, the true lesson is not about avoiding markets or chasing higher returns. It is about recognizing how subtle elements inside financial structures interact with time. When compounding operates for long enough, even the smallest friction within the system can gradually reshape the path of growth.